Why the stock market lost $1 trillion in 2010. Hey guys, welcome back to Front Seat Finance, and in today's video we'll be taking a look at the 2010 flash crash when the market lost $1 trillion USD in 36 minutes. Stay tuned and watch the video right till the end as we take a sneak peek into the past. Before we begin though, make sure to like and subscribe to our channel. Also turn on the bell for the latest notifications and updates. This way, you will never miss another video. With that said, let's begin and get straight into it. In 2010, thanks to Greece's absurd economic policies, the stock markets around the world was having a pretty bad day. But then at 2:32 p.m. for seemingly no reason at all, the stock markets started dropping and losing value like crazy. In just 4 minutes, it lost 300 points, and those who delve into the stock markets already know how huge of a number that is. In just another few minutes, the stocks fell by 600 points. But then a weird thing started happening. Just as it had started falling, it began rising up back again, and within a few hours it had completely recovered. Basically, in just over half an hour, the stock market faltered and recovered. In other words, money disappeared and reappeared just like that. So what happened? Well, according to a SEC report, this $1 trillion, now you see, now you don't, act can be traced back to a firm called Waddell & Reed Financial selling $4.1 billion USD in E-mini S and P500 future contracts. Basically, these are just contracts tied directly to the overall value of the S and P500, which is an index used to see how the market is doing as a whole, close to the 500 biggest stocks on the stock markets. And the people behind WARF for short decided to, instead of doing the trade by an intern by clicking a button for half a day, they would have a sell algorithm handle it for them. Now a trade like that would have happened slowly, but WARF were not worried about time or price for that matter, and they started selling the contracts as fast as possible at whatever price was out there. According to the economic supply and demand formula, when a ton of contracts get sold, especially very quickly, prices tend to dip. But you might be asking, how did a $4 billion trade turn into a $1 trillion loss? Well, the problem was made worse by other dumb algorithms. In particular, the ones called high-frequency trading algorithms, which are designed to make a lot of trades very quickly. Often, HFTs serve as market makers, middlemen who buy up an asset when it's being sold so that when buyers show up, they can turn around and sell it to them and pocket the price difference. Now, seemingly most of the $4 billion contracts were bought by HFTs, but here's something. HFTs don't like holding contracts. Their whole purpose is buying them and immediately selling them. So what happened was, a bunch of HFTs started unloading the contracts to other HFTs, and the process kept going until they were kept being tossed around the market, until there was chaos. That led to another problem. A lot of market makers reached pre-programmed thresholds and led them to exit the market, because the prices were dropping so fast and risk had gotten too high. And when the market makers pulled out, it reduced liquidity massively, and this meant the market plunged even more. Next, what happened was that the futures crash bled into the stock market thanks to arbitrage traders. These traders started selling their stocks to buy the cheap futures version, and all the stocks selling led to the stock market crash alongside the futures crash. So now we ask, why did it end? Well, thanks to the Chicago Mercantile Exchange's stop logic functionality. Basically, the CME has a mechanism where when everything starts going nuts, they force trading to stop. After a 5-minute stop on that day, trading subsided and people realized that stocks had gone down for no good reason, which now meant that stocks were available at a discount, which meant people started buying again, which led to the stock prices rise again to where they had been before. What did the SEC report say? According to the SEC report, they received a lot of criticism from a lot of legitimate institutions, including the CME. Academic scholars published their own research, which led to further Pew researches. In short, they just failed to find out what exactly started the crash, but we did explain everything. So there you have it. This is how the stock markets lost $1 trillion and recovered in half an hour. Thanks for watching.